So what is a market index when we're talking about the stock market? A market index measures the performance of a specific basket of stocks, bonds, or other investments, which are usually categorized in alignment to a certain industry type, such as tech or market capitalization. So let's look at the three major US indices, which are the S&P 500, Dow Jones Industrial Average, and Nasdaq. When it comes to market indexes, there is no limitation to the number of companies it may contain. However, the important factor is that they all contain a sufficient sample to represent the overall behavior of the market segment they aim to represent. For example, the Dow Jones Index contains just 30 stocks. That's because it is based on the largest market capitalized companies. So what does market capitalization actually mean? Well, it means the company's current value, i.e., the number of outstanding shares multiplied by its current share price. So by this, you will also notice that a company's value is just a snapshot in time and is always changing because of its share price. On the other hand, and contrastingly, we have the Russell 2000 Index, which measures the performance of 2,000 of the smallest publicly traded domestic companies in the US, and this is to provide an accurate reflection of the small cap companies segment. There are many indexes, but we will stick to the main ones as our focus. The S&P 500 is one of the most well known, and it is termed as a market capitalization weighted index. The S&P 500 tracks the performance of the top 500 US publicly traded companies as determined by a committee at S&P. Because it is widely considered as the best gauge of large cap US equities, there are numerous funds designed to track the performance of the S&P 500. Then we have the Dow Jones Industrial Average, or simply just known as the Dow or Dow Jones, is relatively small in scope, tracking the performance of just 30 US companies, and is one of the few price-weighted market indexes. The stocks it contains range from healthcare to technology, but are all grouped by one factor, and that is that they are all blue chip stocks. What is a blue chip stock, you may ask? Well, in other words, they have a history of strong financial performance. We also have the Nasdaq 100, which is a market cap weighted and tracks the performance of 100 of the largest and most actively traded technology-focused stocks on the Nasdaq Stock Exchange. Although the Nasdaq covers many different industries, they generally lean towards tech. And finally, a noticeable mention goes to the New York Stock Exchange Composite Index, which is a modified market capitalization weighted index, which tracks the performance of all stocks traded on the New York Stock Exchange. So how are these stock market indexes put together? Well, each stock market index will utilize its own formula in order to determine which companies or investments it will include. An index which measures the performance of a broad segment of the market may only include companies that are top of the rankings in terms of market capitalization. Or in some cases, they may also engage an expert or committee to decide for them, and in some cases, just simply comprise all of the shares on a particular stock exchange. Index weighting. Once an index has decided which companies to include, the next step is determining how those companies are to be represented in the index. This process is called index weighting. All companies included in an index can have the same impact on an index performance or a different one based on its weighting strategy. So the three most common index weighting models are market cap weighted, equal weighted, and price weighted. In a market cap weighted index, as in the S&P 500 and Nasdaq, these indexes represent stock with the higher market capitalizations to a greater degree. With this structure, large companies have a greater influence on the index performance. The weighting of each company in the index is counted by taking a company's market cap and dividing it by the total market cap of the index. Then we have equal weighted indexes, which, as they sound, an equal weighted index treats all companies equally. By this I mean it essentially disregards a company's size and performance, and each company will there influence that same index the same amount. Then we have price weighted indexes. A typical example of this would be the Dow, which solely looks at a company's current share price to give its respective weight. This approach disregards the company's size, and only the ones with the greatest share prices have more influence in these indexes. So how do these main indices compare against each other? So let's look at the S&P 500 versus the Dow. Well, historically, the S&P 500, because of its depth and breadth, is generally the institutional investors' preferred index, as they perceive the S&P 500 as more representative of US equity markets. This is because it comprises of much more stocks across all sectors, i.e. 500 versus the Dow's mere 30. And although the Dow is one of the oldest and most commonly followed equity indices, many professionals consider it to be inadequate representation of the overall US stock market and has been more commonly associated with the retail investor and their interpretation of the US stock market. Another important point to note is the S&P 500 uses a market cap weighting method, which, as stated, gives more influence to companies with the largest market capitalizations, as opposed to the Dow, which is a price-weighted index and gives more influence to companies with higher stock prices. In general, the market cap weighted philosophy tends to be more common than the price weighted across US indexes. So there you go. I hope you now have a deeper insight to the various market indexes, what they contain and why. So that's it. Until next time, if you got value from this, please hit the like and subscribe buttons and also the bell for live updates on top investment options and more tutorials helping you beat the market. Cheers guys.